There was a time when Lehman Brothers was a name synonymous with financial success and Wall Street prestige. With a rich history spanning over 150 years, Lehman Brothers weathered multiple economic crises and came out stronger each time. But what led this financial titan to crumble in 2008, triggering one of the worst financial crises in history? But what led to its downfall? What really happened to this once mighty institution? No more guessing. Let's unfold the story of the Lehman Brothers collapse, an event that sent shockwaves throughout the global economy. What was Lehman Brothers? Founded in 1850 by Henry, Emmanuel, and Maya Lehman, Lehman Brothers started as a small cotton trading business in Montgomery, Alabama. Over the decades, it transformed into one of the largest investment banks in the world, thriving in areas such as investment banking, trading, asset management, and financial advisory. By the late 20th and early 21st century, Lehman Brothers had established itself as a financial powerhouse, making strategic acquisitions and aggressively expanding into new markets. It played a crucial role in shaping the modern financial landscape. But beneath this success lay a ticking time bomb. Who knew what fate had in store for the giant? Inside the successful business life of Lehman Brothers had a meteoric rise in the financial world. It was one of the dominant forces in the global banking industry and was involved in major deals, real estate investments, and mortgage-backed securities. At its peak, the firm had over $680 billion in assets and was the fourth largest investment bank in the US. Money flowing from all streams. One of its major revenue streams came from the securitization of subprime mortgages. These were high-risk home loans bundled into mortgage-backed securities and sold to investors. From the outside, Lehman Brothers appeared to be an unstoppable financial giant. But was it really? What was the scam actually? Lehman Brothers played a pivotal role in the 2008 financial crisis. The firm aggressively engaged in high-risk lending and excessive borrowing. It leveraged itself at an astonishing 44-to-1 ratio, meaning for every dollar it actually owned, it had borrowed $44. Isn't that huge? Not just this, the core of the problem was its heavy involvement in subprime mortgage-backed securities. Lehman misrepresented the risks associated with these securities, misleading investors and regulators. Additionally, the firm used accounting loopholes, such as Repo 105 transactions, to hide billions of dollars in debt from its balance sheet. This gave the illusion of financial stability, while the firm was, in reality, drowning in liabilities. The house of cards was destined to collapse. How did it all uncover? As the housing market began to crash in 2007, mortgage defaults surged. The value of mortgage-backed securities plummeted, and Lehman Brothers started suffering massive losses. By mid-2008, the firm had lost billions and billions and was desperately seeking investors to stay afloat. However, potential buyers such as Bank of America and Barclays backed out at the last minute. On September 15, 2008, Lehman Brothers filed for bankruptcy, the largest in US history, with over $600 billion in debt. This single event triggered a chain reaction, leading to stock market crashes, widespread panic, and the worst financial crisis since the Great Depression. What were the consequences? Lehman's collapse sent shockwaves through the global economy. Financial markets crashed, banks failed, and millions lost their savings, jobs, and homes. Major institutions such as AIG, Merrill Lynch, and Bear Stearns were also on the brink of collapse, requiring government intervention to prevent further disaster. While Lehman Brothers executives walked away with millions, ordinary investors, employees, and homeowners bore the brunt of the catastrophe. Even today, the scars of the Lehman collapse linger, serving as a grim reminder of unchecked financial greed and reckless decision-making. The current scenario. Though Lehman Brothers is no longer in business, the aftershocks of its failure still influence financial policies worldwide. Regulations such as the Dodd-Frank Act were introduced to prevent such collapses in the future by enforcing stricter oversight on financial institutions. In recent developments, legal battles over the bankruptcy proceedings continue. with creditors still fighting for compensation. The 2008 financial crisis reshaped the world economy, and the lessons from the Lehman Brothers downfall remain as relevant as ever. What does the Lehman Brothers collapse teach us? The Lehman Brothers debacle highlighted the dangers of excessive risk-taking and lack of transparency in the financial sector. It underscored the importance of due diligence, risk assessment, and ethical financial practices. It highlights the importance of investors, regulators, and institutions to remain vigilant, ensuring financial stability and preventing history from repeating itself. And yes, the temperamental financial world is not ready for more disasters like these. The collapse of Lehman Brothers is a cautionary tale, one that emphasizes the need for financial integrity, accountability, and responsible investment.